markets have been playing a little seesaw here lately with the new lows and previous lows being tested and taken out in some cases. So let's jump in, take a look at it, see what is going on. And I do have an article to share here in a second as well in terms of what's happening with rising interest rates. But first, let's take a look at the markets. Dow down 0.5%, S&P about 0.21, NASDAQ down 0.25. We'll take a look at the charts and where they stand right now. And the feds are going after the $100 million New Jersey deli scam with the Hong Kong-based Sun at Large. So that'll be interesting to see what happens there. If you weren't following that, that's an interesting story where this little deli that was doing hardly anything raised $100 million in the stock market. Pretty interesting. So a lot of little news here and there. Of course, we have the hurricane in Florida. We've got the war in Ukraine escalating. So all eyes are on the nuclear threat there to see if Putin is actually going to take things to the next level and what the consequences for that will be from the global community. So markets are keeping their eyes on those things as well. And any kind of an imminent threat of nuclear conflict would obviously create a serious event in the markets. And then on other news, we have Cathie Wood coming out today, still betting on her bullish bets on Tesla, Roku, and Bitcoin, doubling and tripling down. And she was also on CNBC today talking about the Fed's policy and how she thinks they're completely missing the boat and that they're pushing the country into deflation, and that's the biggest risk facing the country and the economy in the near future. Obviously, ARK is down still, and we'll take a look at that in a minute, continuing to struggle. But one of the other consequences of the rising interest rates, and we've talked about this before, are companies that have borrowed and highly leveraged, not only companies, but equity funds that are highly leveraged on little to no interest for their debt, are now having to face refinancing. So this company here, Newell Brands, which obviously owns Sharpie and Post-its and a couple of other things, the maker of Sharpie pens and Rubbermaid storage containers, agreed to pay annual interest between 6.4 to 6.6, up from 3.9. They had borrowed $1.1 billion worth. They issued $1.1 billion worth of corporate bonds at 3.9. They had to refinance that. So that's putting a lot of pressure and a lot of stress on their earnings. There's a lot of companies out there right now that are in the same boat. And this obviously is creating a higher bankruptcy risk. And there's some companies here that were very surprising to find out where they stood. Among the highly indebted companies facing bankruptcy are healthcare provider. You wouldn't think healthcare would be an issue, but healthcare provider Surgery Center Holdings, dentistry operator, this is a DSO, dentist service organization, one of the largest in the country, largest DSO in the country, Heartland Dental. They own a bunch of dental practices around the country, highly leveraged. Energy infrastructure servicer, Artera Services, and collision repair provider Wand, Nuco 3. So while these things are happening and bond rates are going up, it's driving the cost of these equity funds capital to go through the roof. So the vulnerability of these companies is partly due to floating rate loans comprising a big chunk of their debt, according to Moody's. While most of the debt-laden companies will remain afloat in the short term, they will have to adjust to higher borrowing costs moving forward. So that's going to put pressure on cash flows, which is going to put pressure on valuations. We're also going to see this start to play out in the commercial real estate market as well. There's a lot of floating bridge debt that was done on especially multifamily deals, but in all commercial assets over the last couple of years. They're going to be coming due in the next year or two or three. And with the rates where they are, these deals are not going to work. So there's a lot of stress yet to come in the commercial real estate market as well. Here's Bitcoin continuing to kind of bounce around here, rejecting on the previous 2017 high right here, right around that 19,000, kind of bounced around, popped up a little bit today to 20,400, and then immediately sold off on that rejection. So still kind of working its way through this little transition area here, hanging on for the next possible moves. And obviously, we'll just have to see what markets do. If the markets take the next leg down, then Bitcoin will likely test that next leg down. But so far, hanging on to that $20,000 level, just kind of ranging in there from a low of 18,000 to a high in the 22,800 range here recently. That was an 18.5 to a 22,800 range. A lot of people were calling for a reversal here, but there will be no reversals. There will be no bull markets while the Fed is hiking, while QT is going on, and while we still have high inflation and things like that. You're just not going to see a full recovery, a new all-time highs, or a bull market recovery. You're going to see bear market bounces, and some of them will be, quite large and severe as we go along here. Again, the markets are not going to bottom until the Fed is done hiking and inflation peaks and starts to come down. Here's the Dow Jones. Again, a lot of people said the lows were in June. And as you know, my position has been the lows are not in for the traditional markets or Bitcoin yet, that we are yet to reach the lows. And the Dow Jones right here has broken well below the June lows and has taken out the previous pandemic high as well. The NASDAQ, not quite there yet, bouncing, finding support just before the previous June lows. And of course, Apple is a big factor here, kind of hanging on and propping up the NASDAQ. If Apple takes a leg down, let's take a look at that. The NASDAQ is not going to stand a chance. But Apple right now is a defensive stock. A lot of capital going into Apple, capital going into Apple as a defensive play, and kind of keeping it up near, not too far from all-time highs. How far is that? Only down currently about, let's see where it closed today. 17%. So not too bad. Still bear market territory, but not too bad for Apple. And the June lows were right here, which is still another somewhere around 13% down from where it's at now. So Apple would have to take a big hit. But if this did, the whole NASDAQ would fall with it and start setting new lows. S&P has broken. So Dow broke first. S&P has now, let's see, did it close? Yeah, closed below the June lows and still has a little ways to go to test the pre-pandemic February 2020 high. So we'll continue to watch and see how that goes. And if this follows like the Dow the other day, the Dow just barely closed below and then continued to sell off. NASDAQ may be next, and then Bitcoin will probably be the last one as the bear market resetting continues. And it's repricing and resetting based on interest rates, just like the bond market is, just like companies that have debt. And that's one of the reasons. So companies are going to have to now take their free cash flow to pay down debt, which is going to affect their earnings and things like that and projections. And of course, with the slowdown that's going on in the economy and inflation, a lot of these companies are, overstocked in their inventories, and they're going to see some sales declines. The holidays are going to be really critical to see how the consumer responds to inflation going through the holidays. And of course, gas prices are a big issue right now, especially with hurricane season. So a lot of economic headwinds out there, a lot of risk in the economy right now, and markets are doing what markets do, following the business cycle, repricing according to interest rates. And right now it is defense. You can get really good yields in bonds right now. The 10-year is almost at 4%, if not crossing 4% today. Let me take a look real quick at that and see what the 10-year did. Yeah, 3.974, not quite over 4 yet. But the 2-year is, and a lot of capital is going into bonds and, of course, defensive stocks like Apple. So these are the things I'm looking at. I'll see you on the next video.